Did you know that you can invest in the stock market with a very small sum of money, with even as little as 5,000 rupees or 10,000 rupees? You can invest in not just one script, but in 50 of the most prominent scripts in India, in the Indian stock market. How is that possible? Let's find out in this video. I'm Surya from WalletWise, and if you're new to this channel, subscribe to us, and you will be getting a lot of content about tax savings, investments, credit cards, insurance, different ways how you can maximize money. And in this video will be specifically about something called index funds. Now, index funds are relatively new to India, but they're not, it's a very old concept. What happens in the stock market is there is an index called Nifty, as you might have heard. Nifty, Sensex, you might have heard. These are two of the prominent indexes in India. The list of scripts include HDFC, Reliance, TCS, ITC, and many other prominent companies in the country. Now, the difficult part for us is that when you want to invest into these scripts individually, you don't know whether you should buy them at that price, or is it a good time to enter, is it a bad time to exit. You don't know all of this. Now, the beauty with an index fund is that you are not buying an individual script, but you are buying all 50 at once by putting in a little amount of money of your own. And what this mutual fund asset management company will do is that it would take all your money, your 5,000 rupees, my 10,000 rupees, somebody else's 20,000 rupees, and cumulatively invest into these 50 companies, which are what makes Nifty 50. Now, how does that matter for you? For example, if I had to buy one share of Reliance and one share of HDFC and one share of Infosys, that might sound great on paper. Hey, that's great. But I am not putting them into the same weight as they exist in the index. How does that matter? For example, if you have been saying that the Nifty has grown in the last 20 years, it has grown about 10 times in price. It was about 1,200 odd rupees way back in the year 2000. And in the year 2020, it reached over 12,800 points. Now it has grown by 10 times. Such value appreciation cannot be seen in any other form of investment excepting the stock market. Now, would I suggest that, hey, go and buy ABC script and you will make money? God knows. You might be successful, you might lose a lot of money in this process. We all have lost money in the stock market, and it's not always as easy as it sounds. But the beauty of owning an index fund is that you are not buying one script, but you're buying 50 different scripts and in their respective weights, as in the stock market. For example, this index would have X percentage of financial stocks, X percentage of Reliance, X percentage of Infosys, and cumulatively it makes 50. Now, another beauty of this particular product called index fund is that you have very low expenses. Every mutual fund, if you have not read the document, charges you an annual 2 to 3% or even can go up to 5% of costs. For example, if you have earned 1 lakh rupees as profit in that year, out of that, not just profit, in fact, it's management fee. So even on your principal, you're losing maybe 2% every single year. So if you have earned, say, only 3% that year and you lost 5% because of the charges, you're in a net loss. In the case of index fund, the expense ratio is extremely low, 0.2%, 0.3%, 0.1% even in some cases. So you really can't go wrong with an index fund. The expenses are not bad at all. The expense ratio is extremely low. That said, what other advantages lie? One huge advantage is that whenever there is a script that is turning weak, I can give you an example. Until last year, there used to be this company called Indiabulls Housing Finance. I'm not going to go into the details of whether it's a good investment or a bad investment, but the NSE index included it into the Nifty 50 because it was performing well. It was growing, there was good dividends being paid out, blah, blah. But at some point last year, they decided that the script is getting weaker and it should not be in the index. Subsequently, it was removed, and in its place, a lot more stable company was pulled in. Similarly, this year, we had Yes Bank, which has fallen drastically. It was pulled out, and then another script came in its place. HPCL last year was pulled out of the Nifty index, and then you had another new script. Some of these new additions include Titan Industries, include Britannia, Nestle. Quite stable FMCG companies have been added. So what is happening here is that if I'm putting a say 1 lakh rupees into an index fund and I just leave it, let's say forget about it for the next 5 years, my portfolio is kind of auto balanced. Whenever there is a script that keeps going down or fundamentally there is some problem with it, Nifty itself is pulling it out and adding it with a new script. Now my fund management company also sells its scripts in India Bulls Finance or in HPCL and buys in the new company in the same proportion. So effectively, it would be mirroring the value that Nifty has. Now, what this means is that if you held on to, say, into the year 2000, if you put 1 lakh rupees in an index fund, today you would have earned 10 times of it, apart from dividend payouts, by the way. So dividend payouts could be an average of say 1 or 2 or 3% depending on the year, how profitable companies are that year. So keeping aside profits, you would earn about 10 times of returns on your value. Now that is huge value. This is like unbelievable. I do not think that gold or real estate or any other investment can give you the kind of returns that the stock market can. Yet the stock market comes with a lot of risk. You might not know where to put your money. You might not know when to enter, when to exit. That's a huge problem. Several of us kind of in a panic, we sell our scripts a lot earlier than our target price has been achieved, and then the script runs away like that. So the beauty with an index fund is that you're not buying into a single script, you're buying into 50 different scripts. A professional fund manager is deciding how much should be there in that index, and automatically, in fact, the best part is that it's automated. Nobody is using their brains. Whenever Nifty's valuation keeps changing, whenever the proportion keeps changing, they sell script, they buy another script, and they balance your portfolio for you almost for free. And the best part is if you're signing up through Paytm Money or through Kuvera or through Coin or any of these applications, you don't need to even pay a entry load, exit load. It's almost nothing. Every single AMC has one index fund or the other. Currently in India, we only have Nifty index funds, but in a mature market like the US, they have small cap index funds, mid cap index funds. They also have pharma index funds. So basically the index is mirrored. This will probably keep expanding in India too. Imagine this. Excepting in probably 3 out of the last 20 years, I think in the year 2008, Nifty lost 51% of its value. And in another year, 2011, it lost about 25%. And this year, currently, it's lost 10%. I am counting it might even lose a little more. So let's just keep your fingers crossed on that. But in the last 20 years, Nifty has risen 10 times, even after losing 50% of its value once, 25% of its value another time. And this year, currently, we are at 10%. It can further fall. In fact, the low of March 2020 was almost 1/3 of Nifty in the high of February was lost. So keeping that in mind, you have to remember that the index will always pay you in the long term. If you are here for the long term, index funds are I would say it's a very safe investment. If you want to be aggressive and want to go and find scripts that can turn into your tomorrow's Amazon or tomorrow's Reliance, great, I'm all for it too. But index funds are meant for people who are happy with stable yield. A 10%, 11% annual yield is almost guaranteed on index funds. This is not the case just with India. Even in the US, you can expect about 7 to 8% annual yield on index funds is kind of a given. In spite of the 2008 banking fall, in spite of the 2000 dot-com bubble burst, in spite of the 1987 fall where scripts almost lost 60-70% of their value, you must remember that indexes have always given about 6 to 7% annual yield, and the index fund in India can give you as high as 11%. Show me another instrument that can consistently outperform that. Not many can do it. I hope this video has been useful for you. If so, share your feedback. I would love to hear what you think about index funds, and if there are any pros or cons, your experiences of investing in index funds and how they have changed your life. I would love to hear that feedback. Subscribe to my channel if you haven't already. WalletWise will be a resource for anyone who's interested in tax saving, investments, insurance, credit cards, or anything in the entire financial industry. Personal finance, to be precise. The idea of this channel is to help all of us save right and save wise. See you again soon. This is Surya. I'll see you again in the next video. Bye bye.